All right, we're starting with our second panelist. I am delighted. Thank you very, very much for your participation in the first panel. Again, continuing the great content we have today. I'm particularly excited about Rabih Moussawi, who's joining us today. He's going to do some slides and then Q&A. He's the Catherine and Richard Salisbury Endowed Professor of Finance at Villanova University. His research deals broadly with financial innovation and the critical role of financial institutions to ensure efficient, fair, and orderly markets. In his recent work, Professor Moussawi examines the unintended consequences of ETFs on liquidity in systemic dry-ups in financial markets and how the increased concentration in the asset management industry reduces diversification and the ability of financial markets to withstand shocks, leading to greater fragility at times of crisis. His publications have appeared in leading journals such as the Journal of Finance, Review of Financial Studies, Journal of Financial Economics, Management Science, and among others. Prior to Villanova, Rabih was a research director of WRDS at the Wharton School, and was previously a quantitative researcher at Barclays Global and taught finance at the University of Texas at Dallas. Please welcome Rabih. Thank you.
Thanks, Mac. It's great to be here. The slides I'll be going over are based on a study with Kashner from Lehigh University and Raisa Veldhuis from Villanova. And what we tried to do, inspired by the work of Jeff Collin in 2017, we tried to drill down the tax efficiency of ETFs, try to quantify it, to assess the magnitude of this tax efficiency in terms of annual returns, and most importantly, to see how much of a role the taxes have played in the phenomenal growth of ETFs in the last 2 decades. So starting from the great discussion with Bob in the previous session, we view conversions as the next phase of growth in ETFs. The conversion started in 2020 with the Guinness Atkinson Fund that Bob worked on. And since then, we've seen dozens, probably more than 100 conversions. We view conversions as the clearest example of this capital migrations from mutual funds to ETF. A mutual fund that, the clients of that mutual fund, overnight, they become ETF investors. So we are seeing the flows going from the mutual fund to ETF. And why it's important in our case, because most of these conversions happen for tax reasons, because of the superior ETF tax treatment that makes a big difference for long-term taxable investors. So we drill down the patterns of flows in ETFs and mutual funds over the last 2 decades. And in this chart, you will see the cumulative flows into ETFs from 2004 onward, the blue line, and the cumulative outflows from active mutual funds since 2004, which is the green line. And as you notice, and this is something that's been heavily covered in the media, a lot of people talk about the underperformance of mutual funds as the catalyst of these massive outflows in the last 20 years. And we hear a lot about cheaper fees that drove a lot of inflows into ETFs during the same period. But how much taxes played a role, and what is the magnitude of that role relative to performance and fees? That's exactly the research question that we try to address in our paper. So as an illustration, I will show you this example. This is something that all investors, all taxable investors must receive in the mailings that the fund will do to, will give to its investors. So this is the summary return for 2020 for an index fund, SVSPX, an S&P 500 index fund. And you will see there that the annual return reported to shareholders for 2020 was 18.59%. Also, that fund reports the return after taxes on distribution, which is more than 4% less due to the taxes on these distributions. When you compare that to an ETF that invests in the same portfolio by the same family, the SPY, you will notice that the difference between the two, the tax burden as we call it, is much less. So we focus on the return after taxes between the index fund and the ETF, and we call it the tax alpha for ETF. And I will show you the measure later on how we compute it. But essentially, this 3.42% is the tax alpha that investors on an after-tax basis receive, even though they invest in the same portfolio and even though the before-tax returns could be the same. So, you know, to be able to quantify the magnitude of ETF tax efficiency, we have to compile, you know, a very representative sample. So we collected data from 1993, from the first inception of ETFs until 2023 on all US equity ETFs and mutual funds. We ended up merging the data with Form and SAR, you know, getting a lot of realized gains and unrealized gains data from there, total redemptions, Form and Port, which was mandated recently. And, you know, eventually we were able to combine, we were able to have a combined sample of about 1,700 ETFs as of 2023, 600 index funds, and 3,000 active mutual funds. So we believe it's a decent sample that we can, you know, we can generalize the results we are getting from that as, you know, about the magnitude of this tax efficiency. Why ETFs are tax efficient? We know because mutual funds are pass-through entities, they have to distribute capital gains and dividends on an annual basis to shareholders following Section 311B. These distributions, in some cases, are not trivial. They can reach more than 30% of the NAV in certain cases. So they have substantial tax consequences for long-term taxable investors. And when there are outflows that trigger the early realization of capital gains that would result in these distributions, at the end of the day, taxable investors, these remaining investors in the fund, end up with tax bills even though they didn't do anything in the fund. This is what we call the negative externalities of fund flows, which is a problem for mutual fund investors. Why taxes are efficient? As Colin tells us in his paper, it's because of the in-kind redemption exemption under the tax reform of 1969 that was originally, you know, created to help mutual funds address liquidity needs and reduce some of these negative externalities. And essentially, this this exemption, which was codified as Section 852b6 in 1986, you know, it stipulates that funds can forego the capital distributions when appreciated stocks are handed in kind to redeeming investors. So mutual funds, because they accommodate investors' flows in cash, they can't take full advantage of this exemption. There are some minimum redemption size requirement, and investors would prefer cash over holding illiquid underlying securities. However, ETFs are designed, they are hardwired by design because of the AP layer to take full advantage of this RIK exemption. So essentially, because the ETF outsources to the APs all these creation and redemptions, and most of them, they happen in kind, they take advantage of this exemption for all the redemptions or most of the redemptions that happen with the ETF. What is the result? What's the outcome of that? ETFs are able to defer short-term and long-term capital gains until the investors sell their ETF shares. This is incredibly beneficial and valuable because essentially it's like you are getting an interest-free loan from the government, as Jack Bogle put it. In addition, it allows the fund to convert the short-term capital gain at the fund level into a long-term capital gain at the investor level. And, you know, for high net worth individuals, you know, for wealthy clients who don't need to sell these ETF shares by retirement, they can give these shares to their kids and benefit from the step-up in basis. So all these accumulated gains, you know, they won't need to pay taxes because of the adjustment in the cost basis. Additionally, because redemption baskets almost always contain securities with the lowest cost basis, you know, ETFs typically have a lower tax overhang when compared with similar mutual funds. And finally, because, you know, your taxation depends on what you do, not what other people do, ETFs essentially eliminate this negative externalities, that exists in the mutual fund flow, which is more fair because, you don't have to pay taxes on what others do. So here is an illustration of, of the realized capital gains for all ETFs, index funds, and active funds in our sample. And you will see in the left chart that, the blue line, which is the average realized capital gains every year for ETFs, is going hand in hand with the red line, which is the average realized capital gain yields for index funds. They are very similar. Most ETFs are index portfolios. The green line is for active funds. It's a little higher, which is understandable because active funds, they trade more actively, and they because of their higher turnover, they realize more gains. Now, even though ETFs and index funds have similar realized capital gains, you will notice in the second chart that there is a big contrast with the first chart. In a sense, the blue line, which is the capital gain distribution for ETF, is almost flat. It's a near zero figure. ETFs do not distribute any capital gains. And these are the averages for the last decade, like from 2013 to 2023, about 11 years, the average capital gain distribution yield for ETFs is 15 bips. If you compare it to index fund and active funds, you can, and we know that many ETFs are active, so we can say, we can infer that the tax deferral, due to ETFs corresponds to at least 3% of AUM per year, in capital gain distributions. So to quantify the ETF tax alpha, we simply compute the tax burden by multiplying the dividend yield, short-term capital gains yield, distribution yield, and long-term capital gains distribution yield by the corresponding tax rates. And essentially, we want to capture what is the additional cost that investors pay on an after-tax basis because of these tax consequences that they face from these distributions. And these are three sub-periods where you can see the distribution yields, whether dividend, short-term capital gain, long-term capital gain, as well as the tax burden computed from that. And I want to focus on the most recent period, 2012 to 2013, essentially by looking at the difference, for example, between the tax burden of active mutual fund, AMF, and ETF. You can see that ETFs have a lower tax burden of 1.05% per year relative to active mutual fund. This is substantial. Economically, this is a little higher than the fee efficiency. So this is how we quantify the tax efficiency, the magnitude of the tax efficiency for ETF. And for a better or a more apple-to-apple comparison, we do this analysis by Lipper class, so by style, basically. So we look at whether the fund is a large cap growth fund or a small cap value fund. Different styles have different magnitudes of capital gains that are being realized. Small cap growth typically have higher realized capital gains, and because of that, we tend to see that there might be more taxes, more distributions, and more taxes. Therefore, and these differences in the tax burdens illustrate that point. So you can see that for styles where funds invest in assets that are more likely to have higher realized capital gains, this difference, this tax alpha, can go in some cases to a level of 1.7% per year, which is substantial. And we matched every active mutual fund to an ETF, not only with the same style, but with similar size, betas, turnover, annual return, and volatility. And these are the numbers from this analysis. Now, we know that ETFs also, they have to trade, they have to rebalance, they have to, drop a stock, a small cap that has been upgraded to, to a large cap index or an acquired stock. So because of all these trades that the ETF, have done, in the next section, Kashner will tell us about some interesting innovation in ETFs, which is the heartbeat trades that exactly address this point. We tend to see the heartbeat trades. I'm not going to spend too much time talking about that. We tend to see it as spikes in the daily shares outstanding, and visualize it better using changes in daily shares outstanding. But what I want to show you is what our analysis suggests about when heartbeat trades are more likely to occur. We found that funds with higher realized capital gains are more likely to have heartbeat trades. And when there are lower ordinary outflows, so there are not enough outflows to siphon away these realized gains, then funds are more likely to use these heartbeats. Larger funds that are more active with higher turnover, with higher return, more holdings, and with more short-term capital gains tend to rely more on these heartbeat trades. But when you look at it on an annual basis, the magnitude of annual outflows due to heartbeat trades is it's much lower than the magnitude of the annual ordinary ETF outflows. So even though they are smaller, but they have a bigger effect. They have a big effect in washing away the remaining unrealized gains before they are realized by the fund. So this is an analysis that we did where we show how outflows have a very different, opposing effect on realized gains and distributions for mutual funds and ETFs. So you regress realized gains on, on all the determinants, including outflows for mutual funds and for ETFs, and you see that, outflows lead to the higher realization of gains. This is the positive and significant coefficient. And then when you look at the distribution, yes, they lead to more distributions, and this is exactly the negative externalities that we talked about. However, for ETFs, you see this negative interaction coefficient. Essentially, ETFs, they reverse the impact of outflows, on distributions because of this redemption in kind mechanism, and they result in almost zero capital gain distribution yield, which lowers the tax burden. And when you throw in the heartbeat trade, you find that each heartbeat trade results in an 18 bips lower tax burden. So for an ETF, typically, ETFs have on average 2 heartbeat trades per year in recent years. So we can infer that, because of the ETF structure and because of the heartbeat trades, after controlling for all, factors, ETFs with 2 heartbeat trades per year, they end up with 86 bips lower tax burden, lower than similar mutual funds. So now, how much these tax inefficiencies have contributed to the outflows from active mutual funds? And here, we run a horse race between, performance, fees, and tax burden in explaining future outflows from the fund. And what we see, so the right-hand side variables, the variables in red are standardized. So you can, compare them, compare their magnitude. So one standard deviation of a higher tax burden results in 1.6% more outflows from the active mutual fund, which is bigger than the effect of fees. It's almost 3 times as big as the effect of fees. And it's almost as important as the effect of performance in driving future flows out of the active fund. So we conclude, we did further analysis to look at the last 2 years, in the period when these realized gains and distributions are reported and before they are distributed, and we saw interesting patterns in the flows suggesting that flows response, and this decision to migrate out of mutual fund into an ETF, taxes play a big role, in that dimension. So the conclusion is that tax-sensitive investors played an important role, a big role in these mutual fund outflows. And in the period before 2020, before we had these conversions, we had 20 years, a little bit less than, we noticed that the trends, accelerated after 2012. But in the period of our sample, we wanted to show that the outflows from mutual funds went into ETFs. And the way to do that, we looked at all the funds affiliated or managed by an advisor. So we aggregated the flows by all these affiliated funds. And then we tried to look at the 13F for that advisor, and we wanted to see how much the advisors with the most outflows of their funds tend to allocate to ETFs, and we found that they allocate much more. So we interpreted that evidence that the clients of these advisors, they are taking their money from the affiliated funds and putting them into ETFs. But the best and the most direct example of how tax-sensitive investors allocate more to ETFs in recent years is by looking at Form ADV and mapping it to Form 13F. So essentially, we look at the clients of every advisor. And if an advisor has more than 50% of their assets coming from high net worth individual accounts, we deem it as tax-sensitive institution, tax-sensitive advisor. And then we looked at their ETF allocation as a percent of their 13F portfolios over time. And this is what we see. So after 2012, the red line tells you about the ETF allocations as a percent of the advisor portfolios for those advisors that have more than 50% of their assets coming from high net worth individual accounts. Basically, those are the tax-sensitive advisors. So you see that it's been accelerating after 2012, and it's reaching about 47%. 47% of their 13F portfolios are in ETFs in 2023. Why 2012 is an important date? Because of the tax law change. So basically, short-term capital gains because of ATRA and the ACA increased from, the short-term capital gain increased from 35% to 43.4%, and the long-term capital gains increased substantially as well. This is the perfect moment. Immediately before 2013, when these new tax rates will take advantage, these high net worth individuals started migrating more and more to ETFs. And we test that in diff analysis. But to give you an idea, when you compare this trend to other institutional groups, they are all in single digits in terms of ETF allocation, with the exception of bank and trusts, which also have wealth management department and tax-sensitive investors. So to give you an idea about the magnitude of the ETF ownership by these tax-sensitive advisors as a percent of the overall ETF market, let's look at the chart on the left. This is simply the aggregate 13F assets by all these different institutional groups. So we want to focus on the advisor with 50% or more of high net worth clients. So they correspond to about $4.39 trillion in total assets. Other investment advisors, that manage different types of clients, they have aggregate assets of 16.4 trillion. And when you look at other institutions, they correspond to about 25.5 trillion of total 13F assets in our sample as of 2023. Now, when you look at their 13F ownership as a percent of total ETF AUM, so you look at the overall, $8 trillion, or if you focus on US equity ETFs, $5 trillion of ETF assets. This is how much these tax-sensitive investors own out of this, ETF assets. So they own 27.16%, even though they are very small compared to other institutional groups, but they own a big fraction of the ETF market. So we can conclude from this analysis that taxes played an important role in the growth of ETFs in recent years. That we quantify the magnitude of the tax efficiency to about 1.05% per year, which is economically and statistically significant. They deploy heartbeat rates whenever they need to ensure that these distributions are near zero. And this is all because of the unique design, security design of ETFs that is very appealing to high net worth clients, that could take advantage more from the step-up in basis and other features. And they found that ETFs, because of that, are more appealing. So we believe that ETF tax efficiency has and will keep propelling the growth of ETFs for taxable investors going forward. Thank you.
Wow, that was incredible. I don't think I've read so many stats on the industry. It's very detailed work, and I would encourage everybody to look up some of these papers that he quotes. I think these slides are incredible. So before we go to the audience, I want to get into a few things. So you've outlined the tax alpha ETF versus mutual funds, and you talk about the drag and because of flows. If you are in a mutual fund today, what would you advise the investor at this point? Do you chase that tax alpha if you're earlier in the stage of your life cycle, or what other considerations? And then does it actually incentivize some of the mutual fund holders, if you do have huge embedded gains, to perhaps push to go to an ETF conversion? Could you see that happening as well?
That's a great point. So we tend, from the data, we tend to see that a lot of these migrations, because at the end of the day, you need to sell these mutual fund assets and realize the gains on these shares. So it depends on investor to investor. We tend to see it more likely to happen in downturns when the realized gains at the investor level are less than in different periods. Sometimes, investors might time it, in an optimal way when they have losses, so they can, use these gains to offset losses. So it might change from an investor to an investor basis. But we use the 2013 and 2012 cutoff as a nice shock, where we can clearly see that, if you wait one more year, you're going to pay higher taxes on these realized gains from selling these mutual fund shares. So you tend to do it 1 year prior in 2012, pay less taxes, and then once you migrate to ETF, you won't have to pay these annual tax bills from these distributions. So that's why we saw, that's why we believe we saw the spike happening in 2012 and continuing afterwards with all the media attention and the great conferences on Section 852b6.
Have you done any work where you actually look at I think I had this slide up there, 25 trillion of assets, the actual tax basis in the funds, just to understand the burgeoning component of sort of the NAV versus the unrealized gains and how much that is? As an industry, I was just sort of curious, and that sort of plays into Bob's work in the conversions. And obviously, my next question, I just sort of curious the answer on that, but next year we're going to be dealing with a radically different tax component in terms of trying to get the deficits down, et cetera. We're going to be talking about that in the next panel. But maybe you could just frame it. We have this industry. Obviously, you've shown the unfairness or perhaps the benefits of moving to ETFs versus mutual funds. But there's this huge component of tax there. I mean, what would you recommend in terms of maybe narrow the fairness? Does it matter that the ETFs have this advantage? And should we be concerned that we have this huge kind of ineffective, unrealized capital gains in those funds as well for the investors?
So for the investors, I mean, the fact that ETFs eliminated these negative externalities, so you end up not paying the tax bill of that's resulting from the actions of other investors who are deciding to sell their mutual fund investments and force these realization of capital gains, and you end up paying substantial tax consequences for that. So this is from an investor point of view, this potentially is a more fair situation than paying these annual tax rates, or tax bills that typical mutual fund investors end up paying. But there are other considerations as well, which is, for example, the evidence suggests that high net worth individuals disproportionately benefit more from these tax efficiencies, and Zach Meider did an amazing job with his colleagues at Bloomberg a few years back to quantify how much deferrals we are talking about. Like in 2018, I think the number was more than 12 billion in 1 year. So we did some back of the envelope calculation for that. We know that at the minimum, ETFs are deferring taxes on at least 3% of capital gains distributions relative to index funds. And if you look at the short-term versus long-term capital gain distributions, like 25 to 75%. So the marginal tax rate is about 25%. So, with $5 trillion in US equity ETFs, you can estimate that the hypothetical annual capital gains distributions that are, that are not being distributed because of Section 852b6 for ETFs, for US equity ETFs, they amount to about $150 billion per year. So if you factor in the taxes, you're talking about $37.5 billion of foregone tax revenues per year. So over 10 years period, that's at the minimum, that's $375 billion of tax revenues that would have gone to the SEC, to the IRS, if those were index funds, not ETFs. I'm not suggesting that one is better than the other, but this is what the numbers suggest. And it's worth kind of, looking at these numbers and the magnitude of them. I mean, Zach and Liz Kashner did amazing work on this. And the more that people are aware of these trade-offs, I think the more informed the discussion and the policymaking will be.
Okay, and the proliferation of ETFs, up until a few years ago was really around index, right? More passive vehicles, spiders, et cetera. But now we've seen a huge movement to active. And part of that is, you could argue, is that the traditional mutual fund managers are now adopting ETFs. Myself, I run an active ETF. But there's differences between running those portfolios in terms of disclosure, right? So, and taking advantage of the ETFs for heartbeats, which we'll talk about later, but just the tax advantages, it encompasses a fully transparent model, right? So you have to disclose your holdings on a basis, and then you have the APs that are able to arb that out, and so you have a very good process of doing that. But it requires a disclosed model, as opposed to the mutual fund industry, which, there's a lagged effect in terms of disclosing 13Fs, et cetera, to their shareholders. So, and maybe it's not so important, if you're managing Berkshire Hathaway or you're owning that, the trading, but in sort of small cap funds, maybe mid cap, there's a decent amount of managers. Can you talk about the dynamics there as managers think about conversions or think about the tax dynamics, but they also want the disclosure benefits, but that is inhibited by the actual transparent, semi-transparent component. So maybe you could just talk about that's the trade-off too, in terms of disclosure, as the rules stand with the SEC in terms of the trading.
Yeah. So a lot of the ETF market is driven by clients. And, from the flow patterns into non-transparent and semi-transparent ETFs, it's clear that transparency is a big deal for investors. And you see how these investors, they vote with their feet, in getting into ETFs that are more transparent, especially active portfolios. Definitely there will be a trade-off between transparency and between, using the best ideas in this ETF space. And given the benefit, from having these APs, doing these, for active ETFs, you are more likely to expect, different ball game in terms of heartbeat trades and these kind of, tax efficiency mechanisms. So, transparency matters in that case, so that you ensure that, investors will end up with the best, after-tax return when all these short-term and long-term capital gains are eventually deferred until the timing that's best for the investor.
Okay. Yeah. Great. Why don't we open up?
Rabih, thanks for the great presentation. I'm putting some solid numbers behind the issues that we kind of talk about, big picture. I was just kind of curious why any of the ETFs have any capital gain distributions. Is that because your study includes years in which custom baskets were not really blessed, and are going forward, are we going to see even a greater tax alpha between mutual funds and ETFs?
Great point. The 6011, it opened custom basket for everyone, even the ETFs that were incepted after 2014. So in a sense, it made the possibility of using Heartbeat much easier, much more efficient, and in this laundry machine and siphoning away the capital gains. So we expected to, at least post 2019 to see more efficient use of these heartbeats to lower it down. Yes, in the period before that, there are many instances for why we tend to see capital gains. Sometimes, in some of the analysis, we weight every fund equally. So smaller funds who don't have necessarily good relationships with APs and market makers, they might not be able to do these heartbeats, especially for short-term capital gains, that they definitely need a heartbeat for that. So they end up distributing these gains. So smaller funds that don't have the ability to leverage their relationships with market makers and APs to help with those sophisticated and complex trades might end up distributing these amounts. But even when you treat all funds on an equal basis, 15 bips is, in comparison, much less than what similar index funds, are paying. And it's important to keep in mind when we look at the tax burden, it incorporates the taxes paid on dividends. So it's not, ETFs, they have substantial dividends, as we saw in one of the slides. So, they would have to result with these tax burdens. So it's not due to the taxes on the capital gains distributions.
Thank you so much for your presentation. I have a question. What would the appeal be for any mutual funds at this point, given how popular the active ETFs are getting? Why would an ultra high net worth individual pick a mutual fund ever if they're losing on tax 3% a year?
That's a good question. So, I want to show you what we believe going forward, and this is our own expectation. It's not, necessarily what is likely to happen in a few years from now. So, in a taxable setting, it doesn't make sense, to put your money in a mutual fund. If we are talking about taxable setting, tax deferred is another story. So according to the ICI in their 2022 ICI fact book, there are about a little bit more than $11 trillion of assets in taxable household and corporate accounts. Building on the evidence and your thought, you'd expect those at some point, whenever it is optimal, obviously, for these investors to shift that money to the ETF. So we're still talking about a long way to go before we can see some equilibrium, in capital markets between ETFs and mutual fund in a taxable setting versus tax deferred setting. If they don't know, probably you need to choose a different advisor. But you are totally right. Yeah.
Hi, Rabih. Thanks again for a great presentation. I was stunned at one of your slides in the middle there that seemed to suggest that tax efficiency was perhaps even more important than performance. And I'm wondering what you think about that. Is this a simple situation where, let's say, it's the January following a year where the S&P is down 10%, and all of a sudden you get a 1099 that says, good news, you've got a tax bill of $100,000 because we've allocated a lot of dividends to you, which causes people to think, hell, I'm going to get out of this thing and get into something else. Is it a situation like that that leads to that powerful effect?
So performance is important, but keep in mind that the tax burden is something, as an investor, you will have to pay, every year. You will have to pay cash taxes on these distributions that you are getting. So in a sense, it's different than, if a fund is underperforming 10 bips on and these are standardized numbers, so they are converted to a standard deviation. You cannot, so essentially, if a fund is underperforming by 10 or 20 basis points, it might have an important effect, relative to a 1%, tax alpha or tax burden for that fund. So both are important, but tax burdens, because of the cash element and because in the long run can have a big effect, and the main reason why they have a big effect, because instead, Jack Bogle will have this famous saying that, who doesn't want to get a tax-free loan from the government to reinvest it in the fund? So the compounded effect of this 1.05% can be massive, especially for wealthy clients. versus the 10%, 10 bips or 20 bips underperformance.
Hi, thank you for the presentation. Very interesting. Just a question on the tax rate assumptions on distributions for long-term and short-term capital gains. What sort of assumptions do you make there about the individual tax rates? I'm assuming it's individual tax rates?
Yeah, so we use, Clemens Sialm has several papers where they use the highest marginal tax returns for investors. Yes, we use we use similar assumption. We build on their analysis, and we get actually the data on tax rates from them year by year over the entire time period. But you're right, we use the highest marginal tax rates for that purpose.
Thanks.
Sure.
All right, so I mean, pretty powerful metrics in terms of the tailwinds or what's driving these trends. Do you see anything changing, in the next 5 years related to this as you identify these things, or do you see it actually accelerating? Or do you see a catalyst for more investor education or more lobbying to perhaps level the playing field for the fairness?
I mean, from an investor point of view, I mean, I'm a teacher, so I tell my students about some of these dimensions because it's important especially for investors in their, and the onset of their career to know about these dimensions so that when they make these investments in their brokerage accounts, they make the right investments, the right decisions. But I think there should be more awareness, about all these issues. And thanks to you for, having the platform to disseminate these ideas and ensure that a lot of these findings are known to everyone, so that eventually there is more education and there's more awareness about the benefits of these different types of decisions, and also like from a policy standpoint, what are the costs as a society that we are paying for? Because at the end of the day, somebody is paying for these efficiencies, from a society viewpoint.
Great. Well, thank you very much. I appreciate it.
Macrae Sykes is a portfolio manager, and Chris Rangi is a co-CIO. This podcast is an excerpt from Gabelli TV that appeared on December 9th, 2024. Yamco is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2024, affiliates of Yamco Investors Incorporated beneficially owned less than 1% of all companies mentioned. The portfolio manager's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the portfolio manager and may differ from those of other Yamco officers, portfolio managers, other employees, or the firm as a whole. Because the investment personnel at Yamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain Yamco personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914-921-5100 fax 914-921-5118 info@gabelli.com.